Liquidity is probably one of the most important topics or concepts that we need to fully understand when we're looking at trading, regardless of the strategy that we are trading. The more that you understand liquidity, the more that you understand where price is likely to go after it sweeps liquidity, after it builds liquidity, gives you a better edge on making better trade decisions. Whether those trade decisions are entering trades, managing trades, choosing target profits, or choosing simply not to enter trades at specific areas, liquidity can be incredibly helpful to understand how to position yourself properly when you're trading. When it comes to trading our particular strategy, we can use liquidity in a numerous amount of ways. One, to validate potential supply and demand areas. Two, look for targets. Three, look for areas that price is willing to go, which could allow a little bit of flexibility within your supply and demand zones, as well as understanding order flow on the lower time frames, as well as on the higher time frames. Because if we have an edge to understand where price is likely to travel to based on where we are in current price action, it gives us a better idea to know whether or not our trade idea is going to be solid or if we're going to have difficulties along the way. Especially if we're seeing, for instance, a trade being executed and we see price getting incredibly choppy, we are able to understand what price is doing or what price might be suggesting it's going to do for future reasons, because more often than not, price is making and creating liquidity for future reasons to tap into later. Liquidity is the gas of the market. We tap into these particular areas of liquidity onto the charts in order to fuel moves for future price movements and to seek that liquidity to then push price to a completely different area. When we look at a chart, we can see that at its core level, the market is moving from one point of liquidity to another point of liquidity. So here we have a very brief markup of the various different key elements of liquidity. There are different aspects of liquidity that I haven't mentioned here, but these are, in my opinion, the most common or the most important forms of liquidity. So the first ones we have are the equal highs and equal lows. This is something that we've spoken about in the content for quite some time. This is where you get either completely equal or relatively equal highs. And basically what this is showcasing is that there is, for a bearish setup, there is a bunch of buy-side liquidity, so buy-stop orders that rest above these highs. Now, there's a couple different reasons why this occurs. One, a conventional trading strategy that I'm sure that we've all traded at one point or another in our trading career is a simple double top. So basically what we were trading at the time is if we got a swing high and we're starting to see a trend slow down, normally at an area of resistance, for instance, we'd be expecting that this secondary top would confirm that we are beginning to reverse and moving to the downside. Alternatively, with double bottoms, we would have two lows, and then that would signify that price is reversing to the upside. And in most cases, it does for a short period of time. But what we later find out and see in the market, that price runs on the liquidity to take the buy side liquidity, to take the sell side liquidity. So if we're looking at a double top, we know that there are buy stops that rest above these equal highs. The buy stops are two things. Anyone who's looking to sell or has sold at these areas will have their stop loss just above these highs. It's a common practice that we see in trading. And their sell orders would be here, which would mean that they would have a buy stop order as their stop loss just above these highs. So if price travels up here, it triggers their buy stop, closes them out of the position, liquidates them at a loss. On the flip side, we also have breakout traders and break and retest traders. If we were simply trading a breakout, you would have a buy stop just above these highs so that when price moves to the upside, it triggers their buy stop, getting them into the trade and looking to take that long. And then finally, what we have is we have break and retest traders, where we would look to break, retest, and then continue, which is why when we see equal highs, for instance, we get basically formations that look like this, because then what this is doing is it's taking the buy side liquidity and it's taking the newly created liquidity by the break and retest traders as well. And it's on the flip side as well for the sell side liquidity, that we would have sell stops right here, as many people would be looking to enter buys here. This would be their protective stop loss. And again, we would have breakout traders who would have sell stops to trigger them into the markets once price breaks those lows, or again, the break and retest traders. And what we more than often see is something like that takes sell side liquidity and then takes the newly created liquidity. Now we can take a look at momentum shift swing highs and momentum shift swing lows, which is really a combination of trend line mitigation and equal highs, because they can kind of come in all the same flavors. Initially, when trend line mitigation is being created, if I just drew a line here, what this ends up being is momentum shift swing highs. And if we get equal highs or relatively equal highs, this is basically what it's creating. This is kind of bridging the gap from equal highs to relatively equal highs, momentum shift highs, and then to the actual trend line mitigation highs. And again, equal lows to the momentum shift swing lows, and then to the trend line mitigation. So what this signifies is that we're creating a series of, in this case, lower highs, and then we're starting to put in lower lows. So what this is doing is creating liquidity for future price movements to return back to, and what we'll often see is price gravitate back to this after we've broken some sort of major swing low. Same thing with the momentum shift swing lows, is once we've created these higher lows, at some point price is gravitating back towards them. Why? Because anyone who was looking to buy, whether it was on a demand zone, whether it was just on simply a break and retest of more of the origin, we could even look at a Fibonacci and see that this is a 61.8 or 786 Fibonacci level that many traders would look to be buying at. Stop losses would be just above swing highs or just below swing lows. So as we know, price is more than likely going to gravitate to these liquidity areas in the future. And that's one thing that we need to understand when we're looking at these patterns, is just because we see equal highs, just because we see momentum shift highs, does not mean that price is just going to automatically run them immediately. What it means is it's an area of interest for future price to consider. We need to ask ourselves, why were these equal highs formed? Why were these relatively equal highs formed? Why were these relatively equal lows formed? Why were these momentum shift lows formed? What is that telling me for future price action? What is that likely going to cause in the future? Because at the end of the day, what needs to happen when price is moving to the downside, per se, is we need to create liquidity so that when price does come back to the upside, we have areas of liquidity to tap back into to then keep pushing price to the upside, or take the orders and then begin to reverse to the downside. And then we can look at the more evolved version, the trendline / mitigation liquidity. And basically what this is it's a combination of these momentum shift swing highs in succession. We can even look at it as almost form of descending channels, because we do see often price doing this. And what we can also see from what we've seen in the past too, we get a spike to the upside and continue. But again, similar to momentum shift highs and momentum shift lows, this is also future liquidity to be tapped into, because if price just keeps moving to the downside, at some point we're going to move to the upside and clear all of the liquidity. And what we can also look at within it when we're looking at order flow, if we start to see a series of supply zones being created and tapped into, this is essentially institutions moving the money. So when they're taking their large sell orders, they're also taking buys, which is why we get buy to sell type price action. So once price moves down here, their buy orders are in quite a bit of drawdown. And then once price gravitates back towards the origin point or their entry point, they close the buys, load up on more sells, and more often than not can also enter more buys. Price moves to the downside, comes back up and mitigates. And this could just keep happening for quite some time until we've created a ton of liquidity, and then you'll just see price explode to the upside. If you need a little bit more clarification on the mitigation process, I do highly recommend the mitigation video that was dropped as well, just to expand upon this theory. And the same can be said for trendline mitigation. On the bullish side, we start to see demand zones being created. Institutions are taking sell and buy trades. The buys are the key trades or the main trades that they're taking, but the sells are also facilitated. That's why we tend to get sell to buy price action. The sells would be in drawdown until they reach back to the original entry, where they close the sells at a break even or slight loss or maybe slight profit. But either way, it's about effectively mitigating the risk on the sells and loading up on more buys. What we might also see is more sells being brought in, more sell to buy price action. Again, we mitigate down, close sells, and basically moving the money as price continues. But then what we can see, similar to the above example, is we can just see this continuing, and then at some point we can see that liquidity get run. And then the final bit of liquidity, or key areas of liquidity to keep in mind, are range bound liquidity. And basically what this is almost the same as equal highs and equal lows. But what we can see is price comes from an impulse to the downside, and then we start to create equal highs, equal lows. Now the range itself can be much longer. We can see price basically do stuff like this: sweep the highs, sweep the lows, and then just start to make bigger ranges. I'm sure we've all seen it time and time again until we initiate out. And what this suggests is that we're building liquidity on either side, and the side that does not get initiated out of, so in this case we've initiated to the downside, there's liquidity resting above here that is more than likely in the future going to be pooled at some stage or another. Same thing with the bullish example. We can see that we create equal highs, we create equal lows. We do end up breaking the equal highs, taking the buy side liquidity, but the sell side liquidity still remains. And at some point in the future, we can see price return back to this area to sweep that liquidity and continue, or even just use that to break through, take all of the sell side liquidity and then continue to the downside. Because one thing to keep in mind when it comes to liquidity, we don't know whether price is just targeting this area to then reverse, or it's targeting that area to continue. At the end of the day, liquidity is fuel and the market is going to use it as it sees fit. And this is when we start to combine market structure and we start to combine supply and demand zones. We know that price moves from one zone to another zone, and we're using liquidity as fuel to move price up and down from zone to zone. It creates it for future reasons and consumes previous amounts of liquidity. So now let's look into the charts. Let's look at some examples and basically just walk through some price action. Now, I've already taken some time to mark up pound US dollar here on the hourly chart, just to kind of explain what we're seeing and give a overall consensus or idea of how price is moving from zone to zone and using future liquidity to target those areas. Now we'll start just on the left here. And as we can see, price is caught in an otherwise sideways range. We initiate out of that range, and then price begins to basically create a larger range. So we can all gain the understanding that here on the hourly chart, pound US dollar is in a range for the most part. What this gives us is we're able to understand range bound liquidity. We know that there is liquidity resting above here. We can also see that even just without referencing the range, we can just see this series of equal highs. If we look into the range a little bit clearer as well, what we can see is we created a supply zone. We've tapped into that supply zone. We have trend line liquidity, or we have momentum shift liquidity. We have a swing low here, a swing low here. What does that end up doing? We see that price comes and breaks to the downside. Then we create a range. We come and we move to the upside, taking this. So we know that this is something to keep in mind for the future. Then what do we see? Let's keep that there. We see that we have equal highs here. That was part of this mitigation of this supply zone. And we can see as we sweep that liquidity, we also create a range in price right here. We also have equal highs, so we've swept that bit of price action as well. We've also, if I just clear up some of this as well, just dig into liquidity just a little bit more, clear that up. We can see that we have trendline liquidity. We have these swing high, swing high, swing high, these equal highs. So we know that there's liquidity resting above all of this area, and even just more specifically, these highs right here. So we have liquidity resting just above these highs right here. And then if we just look, price has tapped into the liquidity of that with this candle that swept all of that liquidity as well. And then that's when we see a true initiation down into the lower price action. Now, if we look, we have this range right here. We've broken to the downside. So we have liquidity that's resting above here. We create a range just like this. We break to the downside. We know that we have liquidity resting just above here. Noticed a newly established supply zone. We've initiated out. And then if we continue moving on, we can see that we have equal highs, equal lows. We have this overall range. So we know that we have liquidity. And what we can see is we break out of that range. We build some trendline liquidity. We break to the downside. We tap into this demand zone. And what we can see as we're creating that, we're creating more trendline mitigation liquidity, because as we can see, we have a demand zone that gets tapped into. We break this structure just barely. We create a demand zone here. We tap into it. We run away. Here's another mitigation. And what we can see, if we just draw a trendline / mitigation liquidity, we then come down and tap into this demand zone, which is yet to be tapped into. As we can see, price just missed it right here. We have a little bit of imbalance. As we can see, when price comes up to the supply zone, we're starting to create all of this really corrective price action, this really wicky and efficient price action that's dropping these very significant swing lows with these wicks. What does that give us? That gives us cause for lower prices. What we can see is that cause is what brings us into this demand zone, which then creates and solidifies this trend line / mitigation liquidity. Then what we can see is we create a range right here. We have equal highs as well. We break to the downside. We create more equal lows right here. We create a little range here as well. We break to the downside, so we've cleared liquidity. So we have liquidity here. We have liquidity here. and then we just keep falling price. We've tapped into this demand zone. We've taken all of the liquidity that rests here. So basically all of this range here has been effectively mitigated in terms of liquidity. There's really no liquidity that's resting within this range. We know that we have liquidity resting down here for future potential reasons. We can also start to gain that we're starting to build some sort of trendline liquidity for a larger move to the downside as well. Then if we keep moving to the right, we have range bound liquidity. We sweep to the upside, then we sweep to the downside as well. And if we also draw in a demand zone from all of these candles, we can see that price taps into this area and we mitigate. So what does that give us? As I had drawn from this point, we also have trendline liquidity that can be tapped into as well. We have equal highs here as well. We tap in, we sweep that liquidity and move to the upside. Now we're developing equal highs as well. We have a demand zone here, which we're not quite tapped into yet. We could see price move to the downside, build equal lows, then tap in and then continue. Why? Because we have a ton of liquidity right there that's resting there. And it's really about just understanding these small nuances, these small bits of liquidity ranges. It's not going to be clear. It's not going to be easy initially, but once you can start to really understand what's happening on the charts, the liquidity that's being created, things become much more clear. We can see that we have equal lows right here. They get swept. Again, we can really just start drawing ranges. We can draw liquidity. And this is something that I highly recommend everyone do when they're trying to understand liquidity. Initially, all these concepts might go over your head. They might seem confusing. They might seem a little abstract. It might give the interpretation that, I cherry picked this range. I've literally just plotted all this out prior to starting this video just to have something to work with. But then as you can see, the logic is all there if we're willing to actually read it and understand it and really just break it down. We can see that price just moves from range to range, creates a bunch of ranges. And this is why ranges become very key. And it's also about asking ourselves, where are ranges being created and does the range make sense to trade? Because often what we have been saying a lot in the content recently, the commentaries, things like that, and within the community is that ranges are an area where fair value is being offered, or at least that there are a large amount of transactions transacting. Price isn't really moving up or down because there's a lot of buying and selling going on. And what that generally implies is that institutions are loading up on positions, or there is at least a large volume of transactions that are occurring. But we need to ask ourselves, when we see ranges, when we see a particular range and we're considering the price action within it, if we were looking at this range, for instance, we see this impulse out, range, impulse out. This would look like a good area to sell, but we also know that we have a supply zone up here and we have a lot more imbalance right here as well. We have some equal highs, maybe not as clear. We have equal highs here that get swept, equal lows. But overall in this range, we have liquidity that would be resting above here, because if you're looking at it from a conventional sense, I used to trade ranges when I scalped, and basically what you would do, and it kind of makes me cringe when I think about it now, but you draw a box. It was called the box and chill method. Basically, you would draw a box around consolidating price action. You'd put a buy limit with a stop loss just below, and you put a sell limit with a stop just above. So regardless of which way the market broke, you would get triggered into a trade. Now, I can see it perfectly with this. What happened more often than not, price would break out to the downside. You get triggered in for the sell. You'd have, your range would be here. You'd get triggered into the buy, so you'd lose both times and get totally destroyed by the markets. Again, makes me cringe just thinking about it, but really understanding how a lot of traders trade, especially when you correlate that with the Asian session, which is what this is right here. This is basically starts from 2 p.m. Eastern and doesn't end until basically the London Open when we initiate out of that range. So this is that Asian session. And a lot of these ranges do occur around the Asian session just because there's a lot lower volatility and volume that's being traded within the markets. But again, it's all about understanding liquidity, understanding the cause that's being created as prices, for instance, moving to the upside. What is this telling us? As we're pushing higher, we're starting to create significant swing lows. And regardless of how you're trading, some people like to trade some type of flag patterns, things like that, where they're going to put their stops. They're going to put them just under there, even break-even points. You can even see that we have multiple small range liquidity that's within all of this. And what we can see is we have range liquidity here as well. We initiate out and then we initiate up. If I can draw that a little bit cleaner. We've taken the buy side liquidity, but we have sell side liquidity. So if we just drag that over, we can see that we break to the downside. And basically what this is allowing us to see is that price has a willingness to trade lower at some point in time. We can also start to see that we have some mitigation liquidity as well. We mitigate here. And then we're starting to see effectively mitigation liquidity starting from a momentum shift as well. We're starting to see price starting to do this sort of behavior, which gives us the indication that when price breaks to the upside, a logical target to be targeting would be up here. We also need to keep in mind that we have equal highs that are forming. So we have liquidity. So this is a pretty key area. As we can see, if we just drag this all over, we're in a much larger range. So if we went up to say a 4-hour chart, for instance, we can see that we're in a much larger range. Where's the liquidity? Where's the liquidity? Now it's all about where is price likely to break out. And that's the thing. We don't know where price is going to break out. If we go on conventional impulse, sideways correction, and then continuation, then a range to this degree would make sense, which would mean at some point we were going to draw on the liquidity. We also have liquidity up here. So everything makes sense. But at the end of the day, price could also do this impulse correction, and then impulse back to the upside, and then we end up having more liquidity, and then we look to the left. Oh, we have more liquidity here. We have equal lows here, equal lows. Again, we're on the 4-hour chart, but this is where you start to piece together all the puzzles. And we can see, if I'm just drawing out liquidity at this point, we have equal highs here. What happens? We sweep those equal highs. But what did we do before? We created equal lows. We swept those, and what we also did was we tapped into a 4-hour demand zone. Just draw it from these candles right here. We tap in and go. So it's basically taking all the sell side liquidity, all the buy side liquidity running up. And what does that show us as we're seeing this run up in price? We have some pretty significant swing lows that are being created. If we just draw it on these two most recent, and then we just match price here. Not only do we have a 4-hour demand zone, we also have this intent, this cause for lower prices. We can see that we have it right here as well. So if price does continue to move to the downside, we're starting to see targets that make sense from a trend line mitigation liquidity as well as a momentum shift liquidity. So again, we'll just go back here, and this is exactly what we're looking for and what we're looking at. So I highly recommend just looking at a chart, grab your pen tool, grab your highlighter, grab a trend line, whatever makes sense for you, and just start marking out the structures. Just start marking it out. It can be on the 1-minute chart, it can be the 1 hour, the 4 hour, the daily. It's all going to work. It's all going to show you the same thing, because at the end of the day, price is fractal, and what you're going to see happening on the lower time frame, you're going to start to see happening on the higher time frames as well. If I go here on the 1-minute chart, what we can see is as price is moving down, we're creating all of these swing highs. This is creating trend line liquidity. If we just move to the left, what happens? We end up breaking that liquidity. And what we can see is we do have a set of equal highs here as well. So it just adds to the fact that price wants to move to the upside. We have equal highs here. We create more liquidity to the downside. We have equal lows, relatively equal lows here. We also have more specifically trend line liquidity here, trend line liquidity right here. And if we just look at how perfectly that taps in here, then we're starting to see mitigation liquidity. And if we move over, we can see we break that to the downside. We start to look and move back here. We can see if I just draw on stuff like this, we have liquidity right here, liquidity right here. I'm just picking random spots, but as we can see, all these pieces start to pull together, and this is why ultimately price is doing what it's doing. If we just move this back to right here, what is this? On an even lower time frame, but we can even see it here on the 1-minute. This is a range bound liquidity, range bound liquidity. What do? We sweep that liquidity there. We also have a potential demand zone that price taps into as well. And then if we just kind of keep moving over, I know this is getting incredibly messy, but I just want to just keep breaking down price action, because liquidity is just so important. And once your mind really switches on to these concepts and understands what's really happening behind the scenes, your trading is just going to take the next step. Equal highs. We have range bound liquidity. We sweep to the downside. We sweep to the upside. We have relatively equal lows, mitigation liquidity. This is a much more smaller. This is basically, actually, if this is kind of a neat example. If we look at this bit of price action, we have range bound liquidity, we have mitigation liquidity, and we also have momentum shift swing low liquidity, and we also have equal low liquidity. What ends up happening, if we just move to the right, price creates the same thing. So if we just draw that in, we create, again, range bound liquidity, equal low, equal highs. We just sweep those areas. Then we moved back to the upside. What we can see is more than likely on a lower time frame, this is probably a clearer supply zone, but more than likely that would be effective to look for that. But as we can see, if we had taken sells from here, something like that, stop loss, let's just do it above the wick just for the bants. But if we were looking for potential targets, one of the first things that we'd want to look at is we have a swing low here, so we know that the liquidity is more than likely going to be run. We have range bound liquidity that has yet to be tapped into. We have those mitigations we've seen, so more than likely price is going to react off of this in some way, shape, or form. And what we can see is as price comes to the downside, we start consolidating. So this would be a great spot to look for partials, because if we look on a higher time frame, this is a potential order block. And what we can see is price comes to the upside, but we fail to break any significant highs. And then price continues to the downside. We then break the equal lows. We continue moving to the downside. What do we end up doing? We start creating trend line, momentum shift, swing high liquidity. We sweep that liquidity. We also create a supply zone. Price taps into that supply zone, continues to the downside. We do have smaller lows here that would probably be visible on a much lower time frame, but that's not overly something that we'll get into since we're already here on the minute chart. I'm only on the minute chart just to show a lot more data and just show how these concepts really do work. We can see that we're starting to get a swing high, a swing high. We get basically, before this candle happened, we had equal lows. We swept the lows. We also had equal highs. So we have range bound liquidity here as well. Price then moves away. What do? We create another range. We come back to the upside, equal lows. We also have sloping swing high trend line liquidity. We continue to the upside. What do we see here? We've tapped into a demand zone. We've created this key swing low within all of this price action. Why? Because at the end of the day, price action, when it creates a major low or high, there's also liquidity resting under those highs. So yes, we do talk about double tops, double bottoms. It's also important to also factor in just really key swing highs that happen almost out of nowhere, because as we see, or not, maybe not out of nowhere, but something that's very prominent. As we can see, this one right here, we just look to the right. What ends up happening? We sweep the liquidity above that high. Why is that? Because anyone who sold here, even on this supply zone or this double top, whatever you want to call it at this point, because it is a supply zone, but it's also kind of equal highs at this point. So we have liquidity resting above here. What ends up happening? We sweep the liquidity, but what did we also do? We created equal highs, and then we look to the right. We've created another swing high. We're starting to build trendline liquidity to come down. We have a demand zone right here. So does price come and then continue to the upside, sweeping liquidity? Very possible. But we also see that we also have trendline liquidity here as well on a series of mitigations. So we could sweep to the downside as well. And this is where liquidity can get confusing, because we don't know where price is going to be going initially, or where it's going to go first before it returns to anything. And what you end up getting is a garbled mess of price action. But this is, again, where you can start to use the fractal nature of the markets and use higher timeframes and lower timeframes in unison to understand where the liquidity is being created and where it's bound to tap into. Because now that we're looking at this on a 5-minute, things start to get a little bit clearer. We have equal highs forming, so we have even more liquidity being formed on a higher time frame. We have equal lows here as well. So we're now creating range bound liquidity. We have a supply zone right here on the 5-minute, so price could sweep the liquidity and then come to the downside, sweeping all of this liquidity as well. We don't know what's going to happen, but again, it's just about filling in price action, understanding the liquidity that we're creating, and just using that to our advantage. You know, we can even see it on the daily chart. We created these swing highs, the sloping trend line. It's also a larger range. What do we end up doing once we get there? We spike into it. Then there's no coincidence that price taps into that. Of course, we react. We also have trendline liquidity here. We tap into it. And then what we can see here on pound dollar right now is that we are creating a lot of liquidity here, a lot of liquidity here as well. Got some liquidity right there. So this could be used for future prices to come to the downside, because we do have a demand zone that's resting down here as well. Getting a little ahead of myself. I don't want to go too much into all of that good stuff, but it's basically about just understanding what's happening here on the charts. You know, we have trendline liquidity. What ends up happening? We're approaching this area. Why are we approaching that? Because there's liquidity that rests above these highs. We had equal highs. We've run on the equal highs. We had equal lows. We've run on the equal lows. Equal highs here, collection of equal highs. It just keeps happening. Why? Because liquidity. And that's why some of these trading strategies that we see that trade flags and things like that, that's why they do work. Because at the end of the day, it's just a form of liquidity. I'm starting to draw patterns and good stuff like that. But again, I'm just looking at liquidity. What do we have? Trendline liquidity to the upside. We have equal highs. We sweep those equal highs. We've created mitigation liquidity. We swept that liquidity. What have we dropped as we've come down? We've dropped swing high liquidity. So we can look at that point as a future reference point. We can go to even to this point, we have trendline liquidity. Where do we come? We have equal lows here. Why did price sweep that? Equal lows, trendline liquidity. We have swing high here. We break that. And this is the concept I'm just trying to point. We've looked at the 1 minute chart. We've looked at a 5 minute chart. We've looked at an hourly chart. We've looked at a 4-hour chart. We've looked at a monthly chart, a weekly chart. Liquidity is fractal. The markets are fractal. All these concepts are fractal. And if we can start to piece together all of these components, this will give us the edge to understanding where price is likely bound to go. Again, this isn't an end all be all because you don't know if price is going to target, say, this liquidity first, or are we going to hunt this liquidity before? Because do we need all of this fuel to then break this area of liquidity to then tap into this liquidity? We don't know. But at the end of the day, what we then can do is build our trade ideas with the understanding that we know where the pools of liquidity are, whether it's on the higher time frame, whether it's on the lower time frame. The higher time frame will help us build an overall bias and sentiment based on price action, and then the lower time frames will allow us to put all of those puzzle pieces together to vet our supply and demand zones, to vet our areas of imbalance, to vet our trade ideas that we're starting to develop. Then when we take them to our entry time frames and we're starting to look for confirmation entries, when we're starting to look for double confirmation entries, when we're starting to look for scale-ins, we can start to pool in where is the liquidity, where's price likely to go. If price is going to pull back, where is it likely going to pull back to? Is it going to pull back and take out equal lows? Is it going to take out equal highs, then target equal lows? Again, we don't know what it's going to do, but once we can plot and understand liquidity, these questions become a lot clearer. So what I highly recommend after watching this video is just opening up a chart. Doesn't matter which pair it is. It really does not matter. Plot out all the areas of liquidity. Make your chart look as messy as you need it to be, because I guarantee that by the end of it, you're going to have a light bulb moment of just totally understanding how the markets are starting to move and then being able to implement that into your trading strategy. Again, it's not going to happen overnight. It's probably going to take a few run-throughs on charts to just start dissecting this. But the next step that you can also do once you've gone through this exercise is start looking at your previous trades and start identifying your higher time frame analysis when you were targeting specific areas. Was it in line with liquidity? Whether it was a winning trade or a losing trade, it can give you a little bit more of an edge or an understanding on why a trade worked or why it didn't work. Maybe you took a 1 minute confirmation entry on a 4-hour demand zone and price looked good based on price action. You see that committed break of structure, you see an imbalance, all the things that we look for, but price still broke to the downside. But then you look into how the confirmation entry came to be, and you start to notice that we started to create more trend line liquidity as we started to come up, which gave us more equal lows or relatively equal lows. Price came down, and then that's when we got that true break of structure, and then we started to get that true trend line liquidity to then break to the upside. Because what we can see is now we're starting to build a case for price to go to the upside, where this is starting to first bring price to the downside. So that's something I highly recommend, is just draw it out on the charts, and then also review your trades, winning and losing, and just factor in the liquidity components that maybe you overlooked or didn't necessarily know. Because at the end of the day, we're forever improving our knowledge on trading. And I truly believe that liquidity and applying these concepts to your trading and this understanding of liquidity is going to take your trading to a whole nother level. It's just going to allow so much more clarity when you're starting to look at things, when you're starting to understand why price did what it did, why it's doing what it's doing, and what that's signifying to you. So I hope this video was helpful. It's a little bit later than what I had initially wanted to do, but I wanted to take some time to really sit down and put together as much information as I can. And again, just walk through price action, walk through this example, whether it was on a weekly, a monthly, a daily, a 4-hour, a 1 hour, a 5 minute, or a 1 minute time frame. We could even go down to 30 seconds and see the same things repeating over and over again. Trendline liquidity, equal lows. We also have sloping trendline from mitigations. We come to the downside. We sweep that. When we can see that we have sloping liquidity. We don't quite get all of it, but what do we see? We also have a demand zone here we've tapped into, and then we run off. just exemplifies that. We can even go to 5 second and start looking at this garbled mess of the matrix that price action is. My computer doesn't even want to load the charts. There we go. And we can, again, start to look at even more fractal price action that's happening in the markets. We're starting to build that liquidity, building that liquidity, equal lows. This is range bound liquidity. I'm not going to go into 5 second because this is just ridiculous to look at. Like, just look at some of these candles. It's confusing. But anyway, I hope this video was helpful. I hope there are a couple light bulb moments that come as a direct relation to this video being dropped. I'm going to continue expanding my knowledge and my interpretation of liquidity as time goes on, as we start digging into commentaries more, as we start creating new content, things like that. But I feel like that this is the foundation of what we're trading in a nutshell. We're then using supply and demand to understand where we're going and where we're likely to react off of from zone to zone. And then we're using that liquidity. We're building that liquidity to then take us to where we need to go. Because looking at this example, for instance, we create these swing lows. We've tapped into this mitigation. We create this range, move to the downside. We sweep some of the liquidity here, tap deeper in here. Then we come down. We've tapped into this demand zone. So we've created equal highs. We've come down. We've created more liquidity up here. This liquidity then fuels us. Look at how big this candle is. Clears all of the liquidity here. We start to create range bound liquidity. We sweep that liquidity, and now we've come back down to fill in this imbalance. And it's all of the components of our strategy into one really nice example that I just thought of as we're going through this now. But again, I'm going to wrap this up. I feel like I'm rambling now. Hope this was helpful.